So hello everyone and welcome to our webinar. My name's Serena. I am a locum GP, a portfolio GP based in London, and I am co-founder of My Locum Manager, the toolkit for portfolio and locum GPs. Me and Hannah have got together today to do a really interesting webinar, which I'm hoping is going to be really useful. So if I just start the
webinar.
Yeah. Oh, there we go. So can everybody see the title slide? If everyone just, can everyone hear me? So if you just type in your boxes yes or no, whatever it might be, then that gives me an idea. So you've got a little hands up button on there as well. So if you've got any questions or you want me to cover a bit or Hannah to go over a bit, you can start on those there. So this webinar is about creating wealth from tax, and it's aimed at GPs, primarily self-employed GPs, but it should cover kind of the whole spectrum of GPs. So we've tried to make it all inclusive to cover things that are going to be relevant for locum GPs, salary GPs, and partners as well. So a bit about My Locum Manager and us at My Locum Manager. So as I said, my name's Serena, and I'm a GP based in London, and that's a photo of me and Matt. Matt's a partner in London, and we kind of set up this site a few years ago now to kind of create a holistic toolkit for GPs who were thinking of self-employed work or were working as locums. And it does all your administration for you, so it will do your job scheduling, your invoicing and tax and things like that. But it also does a whole lot more. So we give a lot of support to GPs. We run webinars like this, so it'd be great to hear from you guys. If you've got other ones that you've got ideas for you want us to cover, then let us know. We're more than happy to do that. We do lots of CPD events as well, and kind of we're focused on helping to financially empower all our members as well and make them financially efficient and tax efficient. So this is just a screenshot of My Locum Manager. So essentially, the new feature I want to tell all of you about before we kick off the webinar is actually now you'll be able to take pictures of your receipts in the expense section and upload them, and that's been thanks to a number of our members that have been kind of sharing their ideas and things like that. So we look forward to you enjoying that, and that's quite relevant for the tax webinar because you need to document all your expenses, as we're going to cover shortly. So just a bit of housekeeping stuff for today. So we've got hundreds of people signed up for today, and I really want you to make the most of today. I want it to be really useful for you. So one of the things you can do on the My Locum Manager resources page, so if you just go to mylocummanager.com/resources, there's a checklist for expenses. You can see that on the right hand side. If you want, print it off and just have it with you on the webinar, because Hannah's going to cover, which is a really common question that we have, like what expenses can we claim? If we buy a car, can we expense the cost of that? What about using your house as an office? What kind of expenses are actually big wins for us as GPs, and which ones, you know, should we get someone to look over and advise on? So that checklist is really valuable. So if you want, download it for the webinar. Otherwise, just have a look at it afterwards. We're doing a live Q&A in this webinar because we really want it to be as useful as possible. So you can send your questions in the question box, or you can, when I open up the Q&A at the end, you can just message me then. If you find it really useful, then do, like I said, share it with everybody, share it on social media, and share it with your friends afterwards as well. And we hope to bring you many more. Now, any of you who are signing in today and joining us, if any of you are parents, you'll know that kids are on school holidays, and in this weather, they don't go to bed on time. And my two kids are exactly the same. And the reason why I'm telling you this is because they are upstairs at this moment in time, and they're still not asleep. So I'm hoping we don't get any interruptions, but if we do, please accept my apologies. So take it away, Hannah. So I'm going to now hand you over to Hannah.
Yeah, okay.
So hi everyone. First of all, just make sure everyone can hear me clearly. Yeah, if you can type in yes, that would be really helpful. So
sorry, I think I've done
that's
something.
okay.
I think I've done something really weird. What have I done?
That's okay.
Oh, there we go.
So first of all, just a little bit about me. As Serena said, I'm a tax advisor and accountant. My business, which I founded since 2014, Exceptional Consultancy, is focusing on the tax advice and accounting services for medical professionals. So yes, I tend to attract like locum GPs. That's actually one of the biggest client base. So I'm also the public speaker and recently published my book, Discover Wealth Through Tax, which is available on Amazon. When I am not practicing tax, when I am not crunching numbers, I'm a black belt in Taekwondo. Yes, that's just a little hobby I do, but it's just in this day and age, we are not really stuck in one profession or one thing. We're just very diverse. Okay, so today we are going to focus on the tax side. Just let me see if I can move the slides. Yes, Serena, would you mind move the next slide?
There you go.
Okay, thank you. Okay, so today what I'm going to cover, I always like to cover first of all is universal rules about tax. That's just the foundation. A lot of you think tax is very complicated, tax is boring, but understanding this universal rule is actually make things a lot easier, which I will show you in a bit. And also maximizing the allowances, also very importantly, saving money on childcare. That's one of a very popular topic. The other thing is sole trader versus limited company, especially for those, some of you might be starting, maybe looking for the potential options, or maybe some of you are thinking of maybe when you are working as a sole trader, maybe the company can be beneficial for you at a certain point. So definitely we'll cover that. And
oh, sorry, Hannah. I think we've lost the screen. I'm not quite sure what. Let me just have a look. Sorry, guys. Just gonna try and open this up. For some reason, it had a. We've got like so many people signed up today. I think maybe that's interfering. It's doing something now. At this point, it's nice to have a bit of music, but we don't have a bit of music. It should open. It's really strange. I don't know why it's
yeah, technology. Yeah, sometimes. Yeah, things happen.
Let's have a look. Okay. Oh, it's opening. It's doing something. Oh, there we go. Right. So, Hannah, can you see the presentation?
Yes, I can. Yeah.
Yeah. So let's go forward to content. Yeah.
Yeah. Okay, so we were talking about sole trader versus limited company. The other thing which is very important is how to extract money from the company, yeah, especially in a tax efficient way. And we'll cover something in tax reduction strategies for 100+ earners. I think some of the tax tips also apply for, you know, basically people who are just salaried, or those who are self-employed, like operating as a sole trader. So when the tips does apply to diverse individuals, I'll point them out in the meantime.
Yeah, that's great. Because I think, yeah, we've got probably a whole kind of spectrum of different GPs doing different roles. So yeah, we should make sure we cover all those. Right, so next slide. There you go.
Okay, so in general, I always like to use this cash flow quadrant to explain the universal rule of tax. Actually, having this visual diagram in mind, it makes understanding tax a lot easier. This idea is not from me, it's from Robert Kiyosaki, the author of Rich Dad, Poor Dad. Maybe some of you have already read the book, know about the concept. So basically, when you have earned income, in general, it's in 4 types. So just let's imagine there's this doctor who is just working for the hospital and is a salary doctor. Then he is an employee. Maybe at a certain point when he's qualified, like most of you, and wanting to do locum work, and then he becomes self-employed. Perhaps at a certain point he decides to incorporate the company and maybe doing some private work or even eventually launch a business. Then he become a business owner. And then when the business is going really well, he wants to make sure his money is working hard for him. So he starts to look at investments. So he become an investor. So yes, there are people in all 4 quadrants, or maybe there are people in 2 of them. So there's nothing wrong with being in any of this. But when we look at employee and self-employed, so these people, basically they are adding value, they are serving the organization, maybe one or a couple at the same time. And essentially, employee or self-employed, you are mostly selling, like trading your time for the salary or for the hourly rate, which is okay, which is nothing wrong with that. But when we look at business owners or investors, so business owners, businesses, they have people working for them, they have a system working for them. Of course, as a business owner myself, I know reaching that point is hard, it's not easy. But when you eventually reach that point, you don't actually having to trade your hours for the money anymore. You actually have the employee, the people working for you. And eventually, when you become the investor, you have the money working for you. So you don't have to work that hard anymore, but then you actually earning the money when it's a bit like a passive income.
So I think really, sorry to interrupt, Hannah, but I think this is really interesting for us GPs, because I think a lot of us are looking at this thinking, okay, yeah, I work an hourly rate or I work X number of sessions, and then I'm working really hard, and then I'm paying like a big tax bill, and there's not a lot left over at the end. And whatever is left over at the end, I think I probably speak for many of us watching this, we often don't know how to invest that money so that it works for us, because it's difficult to know what the right decision is. And I know, like, one of the people that emailed in before the webinar was talking about an ISA that she's put some money in about 5 years ago, and she got initially a good rate, and now it's just defaulted to a really basic rate, and she's not making money on it. And she was like, I wasn't aware I should chop and change them regularly. So I think actually investments for GPs is a very useful way of increasing our cash flow. But I guess a lot of us don't really know enough about it to do it. So, that's quite an interesting thought about that.
Yeah, that's absolutely true. Because I know most of us are working really hard. It's also like these 4 quadrants. The reason why I like it is really give a roadmap of what we can look out for. Eventually, we don't have to work as hard for the money. Yes, when you mentioned we're working hard and again paying a lot of tax, when I apply these tax rates, it just also say on average what are the percentage of the tax that employees are paying.
Yeah.
So yes, I would say, well, some of you are on like 20% tax bracket, some of you are on like 45 additional, but in general, I just sum it up as 40%. So it's like if you're earning like 50K, you are hitting 40% tax bracket. So that's in general. As a self-employed, you pay tax on the profit, so after the expenses. But again, when you are hitting that, say, 50 grand profit, and then you are hitting the high rate tax rate, and then not just you're paying tax, you're paying national insurance on top of that. So I just say nearly half of your profits go to the taxman. But when we move on to the right-hand side, the business owners or investors, currently when you incorporate the company, The company tax is only 19%. And if we look at investors, of course, when you invest money, when you invest in stocks and shares, when you invest in property, you do pay tax, you do declare self-assessment. People do pay tax. For a certain area, like Serena actually pointed out ISA, there is a kind of ISA, which is a stocks and shares ISA. So it's actually you putting the investment into the ISA wrapper. It's a tax-free environment. Of course, there are certain allowances for each year. Maybe for each year the return is not a lot, but the money does mount up, especially with the tax-free element. It can mount up quicker. So that's like 0% tax-free environment. And also certain investments, you do get tax back from the government, which we will talk about a little bit more in the later slides. So just a little bit more note on these 4 quadrants. There are people asking why employee and self-employed working harder than business owners and investors, but it seems they are heavily taxed and earning less money. Yes, business and investors, they are risky. Business owner setting up a business is not easy, and having investors, their investments is risky. There's a lot of uncertainty, but eventually what we can see is business owners, they are solving bigger problems. They want to improve people's lives. They want to boost the economy, creating jobs. And investors, they are providing the capital to small businesses or to the property development. So more people have the house to live. So they are also adding a lot of value to the economy. So eventually, when you are adding a lot of value to the economy, you get more wealth. And also as a reward, the government does give you better tax breaks. So that's just a little note about understanding tax. And the other thing, people ask me when to register self-assessment. There are loads of information online, but the simple thing when you look at the quadrants, if we look at the S and B and I, when you fall into any of these quadrants, chances are you will need to fill in a self-assessment. You will self-assess your tax. Employee, it's not say all the employee, you don't have to do the self-assessment. Yes, your tax is deducted before you get paid, but when you are hitting 100K, you are actually required to fill in a self-assessment. And for some cases, when you have the child benefits, like high income child benefit, like when your salary is more than 50,000, and you do need to do the self-assessment. So just like a few exceptions, but then in general, you can really use the roadmap to look at the tax situation in a very simple way.
Okay.
Okay, so we can move on.
Should I move the next slide? Yeah.
Yeah.
Okay.
Okay, so here we look at the allowances, maximizing allowances. Of course, like a personal allowance, 11,850 for the year. And when your income is exceeding 100K, it starts to reduce. And the tax-free dividend for those who are locoming with a limited company, the tax-free dividend, the first 2,000 dividends from the company is tax-free. But other things I want to also point out, first of all, if you own a home and you have a spare room, and you want to earn some cash by renting out the spare room. So if that's like just under 7,500 for the year, you don't have to declare this self-assessment. So that's just to give you some allowance, some breathing space. And for some of you, I know in the past I do have clients who are asking they having some additional ad hoc income. Say, for instance, they are doing some medical legal work and earn like 500 for the year. So this is actually relatively new. That started from 1718. That is a trading or property income allowance. If that's under £1,000, you don't have to. Well, you can declare if you want, but you don't have to declare. You don't have to fill in a self-assessment form for that.
So one question we had emailed yesterday in preparation for this webinar. Is a GP who is doing part salaried, part locum work and does a bit of Botox on the side.
Yeah.
So for her locum work and her Botox, she was actually putting in both amounts for her self-assessment. But you're saying actually, if it's only about, she's earning £1,000, is that net or gross?
Well, the £1,000 is a gross amount.
Gross amount, okay, yeah.
Yes,
So
gross amount.
wouldn't
There are
have
some
to.
interesting thing about this is, yes, you can still declare that income if you want, and especially say for people setting up a business, they
Yeah,
spend a little bit more money, and it's
yeah,
probably beneficial for them to declare because you can claim the loss relief.
yeah,
Yeah,
okay,
just
yeah,
whichever way is beneficial for you.
yeah.
Yeah. And we have capital gains allowance, which is 11,700. It's actually very interesting. Earlier, someone messaged me saying, "What if I put my own home, buy my own property under the company?" I don't. If you do that, you actually don't have this annual allowance. So that's one of the reasons why it's not worthwhile doing that.
Yeah.
Yeah. Okay, so we also have tax efficient investment allowance, in particular for like salaried GPs or especially or those who are earning 100K plus. First of all, pension is still one good way to mitigate tax and at the same time invest for your future. But I'm aware that most of you having NHS pension. So need to be aware. There's nothing wrong if you want to contribute extra like private pension on top of that. But need to be aware that annual allowance is 40,000. And the other thing in terms of which kind of pension to invest, it's really need to look for like financial advice on which type of pension is good for you, especially when you have NHS pension at the same time. These allowance, yeah.
Sorry to interrupt. So if as a GP, someone's working and they're contributing to the NHS pension pot, are you saying they could get a private pension also up to £40,000 on top of the NHS pension, or is it one or the other?
It's not on top of it. Okay. So that's why you need to know how much you already contributed for the NHS pension. Yeah. Yeah. Because this is a very important consideration as well when it comes to this.
Yeah.
Well, but by all means, if you do get tax relief on the pension contribution.
Okay.
Yeah, the other thing we mentioned about ISA allowance, currently every year you can invest 20,000 to the ISA wrapper. It can be cash ISA, stocks and shares ISA, or currently they have like lifetime ISA. So there are different, a variety of selections, depends on your purpose. But you know, like for stocks and shares ISA, it looks it's more for like long-term investments. If you want money to sit in there to work hard for you for long term, to mount up all these gains, then that's a good way to look at.
Yeah.
Yeah, and other things when it comes to tax efficient investment. Early on, we mentioned the kind of investment that you get cash back from the government. So one of them is called venture capital trust. The other is called seed enterprise investment scheme. And that's actually a very similar category. It's called enterprise investment scheme. So these are actually government schemes that encourage people, like especially high net worth individuals, to invest in certain startups. Like some people, they are doing health technology. Chances are because they are very innovative, they want to solve a lot more like people's problems, or even develop something that is more advanced that people never solved before. Things like if you develop a drug to cure cancer, that's definitely innovation. So Because government want to encourage you for that, they actually give you very generous tax relief on this. So for instance, for venture capital trusts, every £10,000 you invest, you get £3,000 back from the government. Yeah, each year different investments, they have different allowances. We will have a separate webinar on this because it's a lot of detail to cover on this. But here we just mentioned these are out there. These are available. If you want to know more about this, yes, we will plan a separate webinar, or I'll point out more
we will, because this is, again, it's something that as GPs, some of us might know really well, but a lot of us don't really. So again, like in terms of increasing your wealth or making your money work for you, it is a whole topic, as Hannah said in herself, but we will definitely be doing a webinar on this soon, so that you can access that information if you'd like it and if you find it helpful.
Yeah. Okay. So let's move on.
Yeah.
Yeah. Okay. So let's move on to the childcare. So when we look at the tax efficiency and childcare, there are two things that can be very relevant. It's looking at the tax-free childcare and employer-supported childcare. Like the second one is really especially for locum who are running the company, because your company, you are using your company to act as your employer. You are taking the salary from it, and you can use that to do the employer-supported childcare. I have included a hyperlink here, so if you do get the slides, you can actually click on it to look at more information and where to apply if you are interested. So let's get to the next slide. So tax-free childcare is actually, again, is relatively new, but it's a good news for the self-employed. Those are locoming as a sole trader, because in the past, you are self-employed, you're almost having to self-manage all the childcare. But tax-free childcare is actually good news for you. So the condition is really both parents has to be working. None of you have the income that is more than 100K. That's very important. And how it works is for every £80 you put into that childcare, tax-free childcare account, the government actually top up £20. So you get the government support. The cap is £2,000 per year per child. But again, if you can save £2,000, like government give you £2,000 to your childcare, that can make quite a big difference for your cash flow.
And what ages are these up to, Hannah?
Sorry, or what ages?
Yeah.
Well, for tax-free childcare is until the age of 12. But if your child is like disabled, you can become older. Yeah.
Okay.
Yeah.
Great. Shall I move on to the next slide?
Oh yes, please. So we just give a bit of overview, but we'll have a case study on this. For the employer-supported childcare, yes, you use your company act as your employer. It's just like you register a PAYE scheme to run payroll, and again you register your company register childcare scheme to provide the childcare voucher. But one thing you need to be aware of is it's going to close. The window is going to close permanently for new joiners, say from 4th of October this year. So it's actually when that's relevant to you, it's actually a good time to look at which one is better option for you. For some of you, maybe employer-supported childcare it's not really worth it, so better just go for the new scheme. But if that's worth it, yes, after 4th of April, you cannot retrospectively join. So yes, but for employer-supported childcare, you get up to £55 per week tax-free. Again, this depends on your income level as well. It does reduce. So if you are a high rate taxpayer, if you hit 40% tax rate, you only get £28 per week. And if you are more than 150K plus like earners, you only get £25 per week. So it does reduce when your income goes up. So really look at whether or not if that's worth it.
For this scheme, Hannah, if say you're a locum GP, or say you're a salary GP, for example, oh no, let's stick to maybe you're locuming as a sole trader. Could you then, and you're not eligible for the tax-free childcare, could you also run a limited company alongside that and then claim the employer-supported childcare through that scheme?
Well, in theory, yes, because you have the company vehicle and acting as your employer, despite what else you are doing. But at the end of the day, we need to look at whether or not it's worth it to do it.
Okay, so again,
your income is extremely high and you only get a little bit benefit. Maybe it's not worth it doing it.
No.
Okay, so let's look at the example. Just having some some example of before that. This just information like what's the monthly tax-free amount for each type of taxpayers and what are the maximum tax savings. Again, the higher your income is, the lower you get in terms of the benefit. Okay, so let's move on to the next. Let's look at Amy. I think we will definitely email out these slides. I just brief what's the case. So Amy is a locum GP running through the limited company, and her annual earning is 60K. And of course, she takes salary which just cover the tax-free thresholds from the company, and then she takes 30 grand as dividends. So she is a basic taxpayer. Well, her childcare, we roughly look at, if we say like roughly £200 a month, a week, then that's around 11K for the year. Yes, so she is a basic taxpayer running through the company. She has she has two options to consider. Okay, so let's show the next slide, which is what if she does like employer-supported childcare through her company. Yes, she is a basic taxpayer, so she gets a 55 per week childcare voucher, and which is 2,860 for the year. And in terms of saving, she does save company tax on which is like 500. And because she only takes like tax-free salary, she only saves national insurance roughly 300 pounds. But when we take into consideration all the government support and savings, what really cost her in terms of running the whole childcare is only 7 grand, just above 7 grand. So that's actually about 3.5 grand savings. Yes, in that case, it actually looks pretty helpful.
Yeah, definitely.
Yeah. And what if, let's look at the other scenario, what if she uses tax-free childcare? Of course, it's very straightforward. She just register that account and get the government support, which is £2,000. Yeah, childcare still costs her £9,000. So in this case, it's probably better for her to do the childcare voucher. But the situation, actually, one small note, situation can change. Of course, it's not a common case. If the child is disabled, you actually get a little bit more. I think it's 4,000 from the government if you do the tax-free childcare. So that's a rare case, but well, it can happen, but it's not very common.
Okay.
Yeah. So there are a variety of elements to consider. But yes, if Amy is just a self-employed GP, then tax-free childcare, given that no one is earning more than 100K, tax-free childcare is the only thing to look at. But what is very helpful, actually, the government has a link, which is the Childcare Calculator. Because it's like so much details to consider, government has been really helpful in terms of childcare. This link give you the childcare calculator to see what are the options available to you. So you just answer the questionnaire, and then it will populate. So it is very helpful. If you do consider saving money on childcare, I would suggest yes, it's always worth go to the link to look at what are the options. Okay, so let's
the next slide. Oh dear, what is going on? Sorry, it's just, I don't know, it's just collapsed again. Let me just, how bizarre, we've never had this. Sorry guys, just had a few technical issues. There we go. So let's see that. So that should be doing something.
Yeah.
So just
okay.
Right. So it should be loading up. Oh goodness me.
That's okay. Yeah, I think next section we are doing the company sole trader versus limited company.
Yeah, I'm not sure why it's opening now, but it's just a bit. Matt, can you give me a hand with this? It keeps. Okay, so right. So Hannah, can you see the presentation now?
Yeah, I can.
So if I go to that, okay, great.
Yeah. Okay, so let's look at the limited company and sole trader. I think in particular, this is actually very helpful, useful for everyone. Either you are starting out to look at the options, or you already started and to see if that's still the most tax efficient way for you. Sole trader and companies, of course, these are the like a comparison chart I normally use. But since I want to like pick up, first of all, pension is a big consideration for locum GPs because when you doing the limited company, you actually cannot contribute to NHS pension. And also for the company, yes, for the pure tax efficiency wise, company is still better, especially when you are earning when your earning threshold is like very high, less like 50K, 75K, all these things. And also company is a separate entity for you. It's like a separate person. It has its own tax obligation, has to file its own tax return. But the sole trader, all your income, all your profits coming under your name, coming under your income. So you will anything come as a sole trader income, that's liable for income tax. And also things like for the company, it's a vehicle, the benefit of limited liabilities. So when something goes wrong, actually, well, it might not always happen in terms of locum GP, but for the businesses, if anything goes wrong, probably the worst case scenario is the company is dissolved, but it's not going to liable on you personally. But sole trader, you have this sort of risk. But there are certain debts, certain things like if you own HMRC money, and if you don't pay and close the company, actually after that it's under you. So these are the things to consider. But the like downside of company is you have more work to do. You need to keep the records. For sole trader, it's relatively straightforward. So you need to take care of your income and expenditure. For the company, you still need to do that, but it's more advanced. We need to look at the company net worth. It's just like individuals, we have our own net worth. A company has its own as well. So that needs to be reported publicly every year to Companies House. So you're actually also dealing with two government bodies, HMRC and Companies House, for sole trader, you only deal with one of them. So the full information is on the chart, but these are the few things, piece of basis I want to point out. Okay, let's move on to the next. I think next is we are looking at some tips for if you are looking at running a company. First of all, maximizing the deductible expenses, that's very important. But even if you are running as a sole trader, it's also helpful for you in terms of mitigating some tax. I know some of you might be considering you still want to contribute to the pension so that you stay as a sole trader, but maximizing the deductions that does help to reduce the tax bill. But for the company, yes, tax efficiency on taking the money out from the company, it's important. At the end of the day, we want to make sure we take home the money and support our lifestyle. And other things to consider is really your long-term vision. For some people, they say, yeah, I only want to locum for 3 months, and afterwards I want to go back to be employed. And that is fine. It may be for tax purpose, it's better for you, maybe slightly better for you to set up a company, but you set up and later on you don't need it anymore, you close down. That's actually, it's more hassle. So maybe in that case, if the having a company is not in your long-term vision, maybe it's not worth doing that. And I think the next two is something to do with the local manager, the expenses.
Yeah, okay, so very quickly, so shall we start with expenses before we go on to the limited company?
Oh yeah, absolutely.
So one of the biggest questions we get asked, and I always had in my mind, was, you know, what expenses are tax deductible? So if you've already got your tax deductible proforma, which is this one here from our resource center, that has a full list of what's available. So Hannah, I think you were going to cover the big ones like car and stuff like that. If you guys have that with you, by all means flick through that. Otherwise, just with a pen and paper, make notes now, and you can always refer to that after the webinar.
Yeah, absolutely. I think, yes, car is one of the most popular questions. So let's just look at the different scenario. If you are the sole trader, it's actually relatively more straightforward for you. So you can have the option to log the mileage for your business journey. So I know my local manager does the mileage for you. So like first 10,000 miles is 45p per mile, and afterwards it's 25p per mile. So that's very straightforward way. And the other way to do is look at the proportion of the actual cost of the car, like your maintenance, your petrol, and anything that expense on the car. So you need to work out the proportion of business use, but you can choose to use whichever is more beneficial for you. So that's really as a sole trader. For the limited company owners, you can do the same thing as a sole trader. But the other thing, people ask was, would there be any tax benefits to have you buy your car through the limited company? Again, it depends. It depends on, I think, things you need to look at is first of all the car emission, and the second thing is the type of fuel the car use. Actually, it's a very similar concept to look at the childcare. There is actually, I think, there is actually the calculator on this as well. I think if we later on can, maybe we can send that out as well to really calculate that. Because it's another depends on the emission bands. There are 21 band of emission band, and also depends on the petrol kind of fuel that you use. But in general, is if you have a very, very low emission car, chances are you do get better tax benefits. by putting that into the company, either buy it outright or buy it as a lease purchase. But if your car is like high emission, I actually had a rough calculation, is that if like high emission car, you end up paying like 1,500 more in tax, and your tax saving in terms of company tax saving is only 300. So you actually end up being 1,200 worse off. So that's not really worth it when it's like high emission car. Yes, it depends on the emission tier and also the type of fuel you're using. There is a calculator. The good news is there is a calculator on this, which we can send out later on as well. Yes, that's car expenses. The other big area, which is the use of home, because as far as I know, a lot of you you do either do some admin work at home or use a home as office to study, to do the relevant, like well, we call it business related activities. Yes, there are possibilities there to claim expenses, certain expenses, back to the business to save some money, for save money in tax. So in general, there are two ways to look at these things. So when it comes to use part of your home, like you're paying mortgage interest, paying the utility, paying the council tax, we do claim the proportion of business use as a use of home expense. And the proportion is either you can look at the number of hours you work from home in proportion of your total hours spent at home, as well as the other scenario is some people, they have a 2-bedroom home and one of them used as an office. So you can look at the space, the percentage of the space that takes up the entire home. So work out these percentages. So you can claim like mortgage interest, or if you're renting, you can claim the rent, and also utility, council tax, and internet, broadband. So all these things, or home landline, if you do use a telephone for business activities. Yes, that's how you can work out. But one thing, especially for homeowners, because if you are owning a home and if you're looking to sell the home and you are claiming partly as business, and you might need to consider whether or not you've been caught up on the capital gains tax. Of course, if that's a full residential home, you get the private property relief, like there's a residential relief when it comes to capital gains tax, but the business proportion need to be careful. Of course, everyone have £11,700 tax-free capital gain. But if you only use a little bit, maybe it's covered by that anyway. But if you heavily use your home as office, yeah, be careful. Be a bit careful on that.
Hannah, yeah. What about courses? Because that's always a popular question about the courses we can claim.
Yeah. So for the courses, yes, for the like sole trader or limited company owners, you are more open or more flexible when it comes to claiming the courses, especially like your CPD, your conferences, medical courses, all these things. Yes, these are continuous education. These are tax deductible. But there are also scenarios, because as far as I know, some GPs, they are also doing some other courses. So they want to look to do some earn extra income by providing additional service, things like Botox or something that is completely different from what you're doing. So if you are doing a course, a new thing that give you a new qualification to carry on a new stream of service, then that is not an expense. That is not a deductible expense. We see it as an intangible asset, but that's not a deductible expense. But anything, any CPD related to that, any continuous education related to that, these are tax deductible. So yes, these are very common thing to look at. Okay, shall we? Is there any? Yeah, let's look at the. I think we were halfway of Kate. The illustration.
Shall I move on?
Yes, please.
So do you want to just summarize this, because no one would have seen this when
yeah. So I just quickly recap. The first is the 36K scenario with 26K profit. So on the left-hand side, if she is a sole trader, so the total tax and national insurance is at 3,291. And on the right-hand side, as you can see, running a company is more hassle, it's more complicated. So she ended up paying like 4 grand in tax. So in this case, it's not worthwhile to do that. But if we look at the next slide, which is a 75K case, so with this one, 63K profit. Yeah, in this case, she hits 40% tax bracket. So it works out that when she is a sole trader, on the left-hand side, she ends up paying nearly 19 grand national insurance and tax. And on the right-hand side, if she has a company and take dividends, take salary, and then she only pays tax at 13 grand. So the difference is nearly 6 grand. So in this case, it's definitely worth it. Just to support some further information, further content I want to give, here we look at the salary. If the salary she withdraw like 11,800, which is just at the 850, just at the tax-free threshold, tax-free allowance, and then she takes another 34 grand as dividends, which is exactly cover the 20% tax bracket. There is a reason for that. Well, unless she does need the extra money, but we can look at that case differently. But there's a reason for that. She does not withdraw everything. That's really for the tax purpose. But just have this in mind. We'll talk about some content that is related to how she is extract the money.
So shall I go to the next slide?
Yeah. Yes, please.
Yeah. There you go.
Okay. So yes, when it's worthwhile, of course, considering the admin burden, it's not just the tax, but also other costs involved in running the company. And of course, the higher your earnings are, the bigger the difference is. And also consider other source of income. I think we mentioned that briefly earlier on, that if Kate in the first scenario has a salary income already, maybe for anything additional, it could be beneficial for her to have a company because it's not adding up to her own income. Yes, when it is worthwhile. The other thing, perhaps, when you look at the case from Kate on the second scenario, 75K scenario, because she is hitting 40% tax bracket on her profit. So that's one of the reasons why it becomes worthwhile. The tax benefits becomes clear because of the 40% tax bracket. But well, that's when you run in the limited companies, you paying tax, like company tax is 19%, and you paying a little bit on dividends. Okay, so I think we can go to the next bit. Withdrawing money. As a sole trader, you can just take cash randomly whenever you need, as long as there's enough money to pay the expenses and pay the tax. But for the company, you either withdraw money from salary or dividends, or sometimes you might take director's loan, but be careful, there might be additional corporation tax charge if you don't pay off the director's loan at certain time frame. But we would look at details in separate webinar on this. Yes, when you do taking salary or dividends, it does trigger some tax. That's why we need to look at what's the proportion of salary and dividends. So yeah, if we go to the next slide, yeah, we have like salary and dividends, how it is taxed differently. Yes, for salary, you of course get a tax-free. You first 11,850 for 18-19 is tax-free, and then for national insurance, roughly the first 8,000 is national insurance free. But when you do paying yourself salary, it might, even if you're paying yourself 11,850, there will be some amount of national insurance to pay. So these are employees and employers' national insurance. But dividend doesn't trigger any national insurance. Currently, in 18-19, you get the first £2,000 tax-free as dividends. As earlier on, we say Kate takes 34 grand as dividends, just cover the basic rate band, because she only pays tax at 7.5% on her dividends. If we just take that, anything additional, that would be taxed at 32.5. So that's quite a lot. Yes, if that's enough for her to carry on, that's fine. And the other trick is actually the timing of the dividends. So if that's just at the end of the tax year, and she does need extra 5 grand, and then maybe she can just she can take 34 now, just cover the just pay tax at 7.5%. And moving on to the new tax year, if she hold off for the couple of days until the start of the new tax year, it will be the new set of tax-free dividend threshold, and also the new set of basic tax rates on dividends. So that is one of the tricks. The timing of dividends is one of the tricks on taking money out of the company in tax efficient way. Okay, so let's move on to the next slide. I think the lighting is on and off. That's just anyway. So if we look at the case, yeah, we were talking about the timing of dividends. Yes, by moving the timing, you can save quite a bit of money on the same amount of dividends. And we go to the next one. Let's go to the next one. Yeah, we mentioned a little bit about being employed and running a company at the same time, but also this also applies to being self-employed as well as having a company at the same time. Because I know some of you might having being a sole trader for NHS work, because you can contribute to pension, but you also have some other work like private work, which earns about 20K, something like that, and then you use a company so that it's more tax efficient to run that way. So if you having that like both the same time, we don't normally suggest to take salary out of the company. We always suggest just take dividends whenever it's available, because despite your income level, the first 2,000 dividends is tax-free anyway, and dividend doesn't trigger national insurance. So it's cheaper to do that way. Okay, let's move on to the next. Just some extraction strategies. The company, for the company, if you're running a company and you know that you don't entitled to contribute to NHS pension, but you can use a company to set up a company pension scheme to contribute to personal pension, like any sort of private pension. So that's again a good way to maximize the deduction and at the same time to invest into your retirement fund. Childcare voucher we have mentioned early on. It can be a good strategy. Employee, a spouse or family member, Yes, for some of you might have family member that are working for the business, do some like bookkeeping work, do some admin. So if they are doing the work, and you might consider giving them a salary as a reward of their service. For this, I just put some mark in there because you cannot do it in an artificial way. If you are giving the spouse or family member the salary, of course, it's very tax efficient to maximize the take-home pay as a family, but you cannot do it in an artificial way. If you are giving them salary, they have to do some work, provide some service for the company. And the other way, yeah, again, sharing the ownership, giving your family member some shares. And when you do declare dividends, you actually split the dividends, and then you actually have two set of tax-free dividends allowance, and two set of basic rate allowance, basic rate band. So that can be very tax efficient as well. Again, you cannot do that in an artificial way. If you are sharing the ownership, make sure your spouse or family member, they are actually making strategic decisions for the business. Or it can be, it's not hard to articulate all these things like making decisions or giving services. But the thing is, you cannot, you get to document these things. You cannot do it in an artificial way. So even just a very simple piece of documents or an email that can do. So it just get to be something in black and white.
So Samreen is a GP that signed on today, and she's tuning into the webinar. And this, I guess, what you're saying relates to her question, and what another question a lot of people have asked, which is her example is she earns £50,000 through her salaried job. And then she locums on the side, but does that through a limited company. And her question was, what is the most tax efficient way for me to withdraw money from my limited company? So I guess actually all these points that you're saying are relevant to that.
Yeah, all these can be relevant to that. And of course, like early on, we had this scenario like employed and having the company on the side. Of course, having that £2,000 tax-free dividends, that's very helpful. And other things, yes, articulating all these things, this can be helpful as well if you do have a family member do the work for that business. Yes, that can be relevant.
Yeah, okay. Would you like me to move to the next slide?
Oh, yes, please.
Yeah.
Okay, so we just summarize this whole limited company and extracting money from the company thing. So first of all, company director, you do not subject to minimum salary rule. So that is why low salary, relatively low salary and high dividends it's still tax efficient because dividend doesn't trigger national insurance and dividend tax rate is relatively lower. And also, yeah, when you have other source of income at the same time, and it's better to just take dividends from the company or consider other options that we listed in the last slides. But again, it's not one size fits all. So always no harm to speak to an advisor on what's the strategy for you. Okay, let's move on to the next. This is for the 100K plus earners. I think for this webinar we just brief what's out there, but because it does include those tax efficient investments, we will certainly have a separate webinar on these things.
Yeah, definitely. Yeah.
Yeah, but what happened with 100K plus is you start to lose personal allowance. And for instance, if you are earning, your income is like 102,000, you lose £1,000 of personal allowance. So you only have 10,850 rather than 11,850. And bear in mind that you lose your personal allowance completely when your earning is over 123,700. So that is why First of all, you might look to protect the personal allowance as much as possible. But if you cannot, you might look at some other strategies, like one of these tax efficient investment. Because imagine you have $3,000 back from the government, and then you can make a big difference. Okay, so let's move on to the next slide. Yes, when you hit 100K, you actually do submit self-assessment, even if that's employment income. You do hit 45% tax bracket when the income is over 150K. And again, the pension annual allowance, early on we mentioned is 40K per year, but it actually starts to reduce. So the higher your income is, the less you are allowed to contribute to your pension pot. So it does start to reduce.
Shall I move on?
Yeah, yes, please.
This one?
Yeah. Okay, so since that you can protect personal allowance, or some of the strategy actually also can help those who are just salaried or like just self-employed. Yes, pension contributions still very good. Of course, for most of you, you have NHS pension. When it comes to getting pension advice, that NHS pension need to take into consideration on this. Charitable donations.
Sorry, we've had one question come up. What is the allowance? What is the reduction of the annual allowance to?
Okay, so well, when it comes to reduction on annual allowance, I think the minimum you can still contribute is 10,000. But when you hit 150K, again, it's on the tapered fashion. There's a tapered threshold, but at the end of the day, the minimum too is 10,000. So anything in between 40,000 and 10,000.
Yeah. Okay.
Yeah.
Thank you.
Okay, so yeah, charitable donations, it can be also helpful as well if you do support a certain charity. When you are higher tax rate taxpayer, you do get certain tax relief on that. And the charity, if you do like gift aid, charity can also claim tax relief for them as well. So that can apply to when you are salaried, as well as when you are self-employed. Salary sacrifice. So if you are employed, it's really down to how you negotiate the contract with your employer. But what I have seen, especially for those who are working within private companies, like working as a doctor in a private company, what they might do sometimes is, instead of having a pay rise the next time, they ask the employer to pay for their indemnity or pay for certain expenses, because these are tax-free anyway. But then your taxable income will stay below 100K. But the good thing is you ease up the cash flow. Instead of paying these things out of your pocket, you have the company pays for that. And of course, claiming expenses. Even if you're an employee, you still, claiming tax rebate on the membership, on the indemnity and certain courses. You can still do that even if you're an employee. And of course, self-employed maximize that. And cash extraction strategies for those who are having a limited company. Yes, we mentioned what are the tax efficient way to extract cash from the company. Okay, so let's move on to the next slide. So we just briefly talk about the tax efficient investment. So these are basically the government scheme for high net worth individuals to invest in small UK businesses who are like very innovative. In particular, those like healthcare startup companies, or those companies who are doing loads of research and development, and things like they are developing the drug to cure cancer, or all these things, all these innovative things. and investors do get a percentage of the investment as tax relief. And this can be very high risk investment because you're investing in small businesses. And I would always suggest this, you do need to seek for independent financial advice because it involves risk, and also need to look at how much risk you are able to afford, and how much risk you can tolerate, or if that fits into your overall investment strategies. So yeah, do need to seek for advice. Okay, so I think we come to the end. Just to summarize, we've been through the allowances, tax-free childcare, the tax efficiency on childcare, sole trader versus company. Most important thing is withdraw money from the company, and the briefly on tax strategy for 100K plus earners. So some of the strategies I have pointed out in between that can be relevant to like salaried or sole trader audience. Yeah, by all means, these are the content we cover for today. I hope that's been helpful. I think we've
got lots of questions, so I'm going to try and get through as many as we can. So let's have a look here as I try and go through. Oh, I can see my fireplace, but they can't see me. Okay, so let's go down. Right. Sorry, I'm just trying to go through. We've got so many questions come through. I'm just trying to see. Okay, so oh my goodness, so many, so many questions. Right, which one do I start with? Okay, this is quite interesting. This is from Ajay, and he's saying, can you please advise whether working one session a week doing research through an innovation vehicle has any tax benefits? That's quite different.
Okay, that's very interesting. So first of all, I just want to clarify, like one session a week and doing research. So was that on top of your normal earnings, or that's your, well, it depends. I suppose you might have other source of income at the same time. Is that a question? Was that a question like include?
Yeah, so what he was basically saying, so if he's doing one session a week as a research through an innovation vehicle, has that got any tax benefits? I'm not sure what to make of that question. I don't understand it, but maybe you do.
Innovational vehicle.
I think Ajay, can you give us a bit more detail on what you mean by that, so then Hannah can address it better. So Matthew is asking that can he expense lunch, for example, and is there an amount which the HMRC can accept without a receipt?
Okay, that's again a good question. So basically, when it comes to talking about locums, if you are either sole trader or freelance, like limited company owners, lunch, like day-to-day lunch, is not deductible, but there are certain circumstances. There's this thing called subsistence. Basically, if you are required to work elsewhere, somewhere else, outside your normal office space, if that is more than 5 miles from your normal office, normal workplace, and you've been working there for more than 5 hours, you can claim lunch. In terms of without receipts, well, record keeping is basically your own responsibility. Normally, HMRC does not. They do not personally check everyone, but yes, of course, I would always advise you document as much as possible. But in regarding to receipts, it's really for your record keeping. Even if you lose the receipts, you need to have the record somewhere. either you have a bank transaction or you have a note to specify that is outside your normal office, that is you're working there, or specify, make some notes on that. So even if you don't have the receipts, well, somewhere you do need to make a note of it.
Yeah, and now actually, Matthew, you can actually capture all your receipts on My Local Manager, so you can just have it all stored there, so you don't need to like have loads of different places to keep it. So that might hopefully make your life easier. So Shalaja is asking, is it true if you work more than 6 months as a locum in a particular surgery, you need a 1 month break and not pay pension for that month, as it's not valid because HMRC will view that your work was over 6 months and you're now pay as you earn?
Okay, that's again very interesting question, because it's actually trigger something probably lots of people know about IR35. So, well, in terms of like working with one practice, of course, if you've been there, like at the moment, when it comes to temporary work or all this project work, the length is not really very relevant. But normally, when it comes to consider IR35, the length is actually when you are working there for more than 2 years. You might need to be quite careful on that. And when it comes to being seen as PAYE or being seen still as a genuinely self-employed, it's really down to the work relationship with your practice. So it can be that if your practice have a very significant control over you, do you expect to work a certain way? Are you able to hire a substitute? So it's more down to the contract and the working relationship with that practice. So even if you only work for like less than 6 months, but then the fact that you have less freedom of how you work, then chances are it's like falling more on the inside IR35 side. So it's a gray area. It's more on the high risk or low risk. Yeah, but we do have a separate separate session or something on that topic.
Yeah, we will. And for so Mohammed is asking about more details about IR35. So that in itself is a whole nother webinar. We have a webinar on that from last year on the My Local Manager Facebook page. And also, if you go to the resources section of My Local Manager, there's a survival guide, and in there's a very detailed but very simple chapter about IR35, what you need to watch out for, and how you can protect yourself being caught up in the loop of it. So you can just download that for free and have a look at that, and that should answer a lot of your questions. So then Ajay is saying, poor Hannah's been thrown in at the deep end, because I think that's when the slides went, but you handled it like a pro, Hannah.
Thank you.
In the background flapping like, where are the slides, where are the slides? Okay, so Amjad is asking, how does a limited company actually join a childcare scheme?
Okay, that's again very good question. Actually, the company, you have to like register separately with a childcare provider. Actually, yeah, it actually reminds me, I do have a list of childcare providers where you can look into, and then there'll be guidance, there'll be contact, where to go in terms of joining the childcare voucher as a company. So I do have the list on that. Perhaps that would be helpful.
Yeah, we can send it out. We can send it out to you all after the webinar. It's not a problem. And then Jawad is asking, which we covered actually, is it worth purchasing a car via my limited company?
Okay, so just to recap in terms of purchasing a car. So it depends, you will need to look at the emission tier, the emission band, as well as the kind of fuel you're using. So basically, when you purchase a car under the company, because there's this element of personal use, it's actually also the taxable benefit for you as an employee of the company. And the higher the emission is, the more tax you will have to pay, like a tax on the benefits you have to pay. So it's really look at whether or not if that's worthwhile to put in the company, the general rule is if that's a very low emission car or like electric car, it can be more beneficial to put in a company, because yeah, government like to be tax like environmentally friendly. So yes, the chances are you pay less tax on the benefits, but then you actually get a full capital allowance towards the company tax. So yeah, that's
Okay.
yeah.
Samita's asking, so she's hi Samita, she's a portfolio GP with 5 different roles. Oh my God, how are you, 5 different roles? That's a lot of work. 2 of her roles, she's employed and she's paid PAYE. The other 3, she's self-employed. Would it be sensible for her to set up a limited company and have a private pension and still pay into the NHS pension for the other 2 roles?
Okay, that's a very interesting scenario. Of course, when it comes to your other work, depends on what you are doing, and if that's like a private work on top of that, and also see how much you are earning on the other side. The chance, if we look at the tax efficiency, like pure tax efficiency, it looks like your other work is better to have a limited company because you are not everything. If that's a sole trader, everything, all the profit earned from that side is taxed under you. But again, depends on what you are doing on the other side. For some people, just perhaps not really relevant to everyone, but some people, they are actually earning a little bit money on the side as a business, but they are actually spending more than they earn for that side business. So in this case, it's not beneficial to have a company because if that's a sole trader, you can claim a loss relief to save some personal tax. So it really depends on what you're doing on the side. What are the profits on this is very important. Yeah.
Okay, so I guess it is potentially possible, you're saying, but she just needs to speak to somebody and get advice about how beneficial it would be. Okay, so then we've got Shalaja's asking, my accountant says you cannot claim car mileage for regular locum work. Is that true?
Okay, so that's a very interesting scenario because regular locum work, again, it can touch a little bit IR35 side because when it comes to you cannot claim the regular mileage on locum work, and that chances is maybe your regular locum work, first of all, maybe you've been in the same practice for more than 2 years and you are falling in more like high risk of IR35. And the other thing is, yeah, it's like the practice you've been working there is potentially being identified as a permanent workplace.
If it's just one practice and you're there day in, day out, then I guess that is kind of IR35 territory. If you've got your bank of your group of practices where you go and your sessions vary and you're doing different days and some days you're not there, etc., then I guess that is regular locum work, but it's not a regular pattern of work, if you see what I mean. So I guess in that case you'd speak to your accountant and just make sure and do the HMRC tool online as well. And she's also asking, can you claim for car service or car breakdown costs?
Okay, so in that case, depends on what you've been doing in terms of your claiming your car. So if you're already claiming mileage, you cannot claim these things on top of that because mileage already covered everything. But if you are using that proportion of that, then you can still count that and count the proportion of that. That's a case of when you are using a personal car. If that's a company car, yes, that can do. But yeah, again, need to consider the benefits, taxable benefits element.
Yeah, and Mayreen's asking, so hi Mayreen, she's asking, can we please have a webinar on investment? Yes, we are doing a webinar about investments as GPs and what to look for and how to do it. Navdeep, the person after my own heart, is asking, can you use clothes as a tax deductible expense?
That's very interesting. Yes, clothing is another, it's not a relatively popular question. So the general rule is unless it's a uniform or the special clothing that you definitely have to wear when you're doing the work. If that's like a suit, like people ask me, I wear suits for work, can I claim that? It's actually not, because the kind of suit you can wear in a wedding, you can wear for the personal occasion. So it's not. But if that's the sort of clothing you're not going to wear apart from doing the work, then yes. Or if the clothing if you have a company and you have the logo on that, that is fine.
PP, Armani.
Yeah.
Okay, Hannah, what if it's a cardigan with elbow patches and you wear it to your GP practice?
Oh,
That's
wow.
kind of like a uniform for some GPs.
Did you personally buy it? You purchased it, right? Or
yeah, just like, cardigan patches, go to a GP practice. That's kind of like a uniform for some of us GPs. Maybe we could try and expense that. I don't know. Okay, so Navdeep's also asking, can you use lifetime insurance and critical illness cover as a tax deductible expense? That's a really good question.
Oh yeah, that's really good question. When it comes to this sort of, it's fall into like protection wise, like income protection or anything. In general, I wouldn't put through as a tax deductible expense, because what happens is when you fall ill, when you do need that cover, when you do need the income from that, if you claim as a tax deductible expense, what end up having when you are falling ill and getting that source of income is that becomes taxable. But if you're not claiming that, then when you are falling ill, you get a payout, then you just get a payout.
Okay, so we've got loads of questions to get through and I'm conscious of time, so I'm going to just blitz through these as quickly as I can.
Yeah.
So hi Mohammed. Mohammed's asking, if one has a parent or holding company, what are the benefits or implications? So just a quick summary point on that, Hannah.
Okay, so when it comes to the parent company, I suppose it's like one company owns the other company.
Or like a holding company.
Yeah, it's like a parent company. Of course, for the company themselves as an individual company, it's still like as normal, declare the tax and everything like that. But unless you have the intercompany transactions, so we need to look at what are they? Are you sort of like moving money from one to the other? So it's really transactions between a company. What are they? Is that a dividend payout, or is that actually service provide to each other? But otherwise, as an individual company, other things is fine as it is. It just look at, identify, really to document what are the transactions between these two companies, because tax implication is different.
Yes, I think, Mohammed, you'd probably need to speak to an advisor and go through where the money's moving to and how it's moving as to what the benefits and implications.
Yeah, and what they are doing in these different companies.
Ashraf, hi Ashraf, is asking, if you're a part-time GP partner and also working as a locum through a company, what is the best way to be tax efficient?
Okay, the best way to be tax efficient.
You're not getting easy questions today, are you?
Well, you are working as a partner, which is, it's like you declare self-assessment. It's like personal income, and at the same time you locum, well, the limited company. Of course, for this, looking at this alone, it's quite a sensible way to do, because you're using the companies for other source of income, which is not everything adding up under you. Other things you can optimize is really how you can optimize the company, like in terms of using the money in the company, like ways to extract the money if you need, or what are the things you can do within the company to optimize that. So again, I think when it comes to utilizing all these strategies or tax efficiency, the other thing you need to consider is your lifestyle needs. Do you need this extra money, or do you not need that? So how much you need, and then we can work a little bit backwards to see how we can meet your needs the best way. the most tax efficient way.
Okay. Ayan is asking, how often can money be taken out of a business account, and is it okay to leave 20% of each income coming into the account and take the rest out?
So how often, the frequency of taking money out of company?
Well, he says business account.
So the business account.
Business account, yeah.
Okay. Depends on which way. So there's no certain rule, certain hard rule saying like you need to follow a frequency. But normally what people do is for salary, we run a monthly salary if we need. And dividends, again, you can choose to do like monthly or quarterly, yearly, it's up to you. And also for director's loan, if you do need cash, I wouldn't suggest you take a director's loan that randomly, because it does get messy. But if you do need money outright for certain things, you do need to take money from the company, like borrow money from the company, then you do take it, but make sure you do put it back, like repay it or release it within a certain time frame. Yes, we can actually have a separate session on this withdrawing company, and also like be careful on the additional company tax charge when you are leaving the director's loan for too long.
Yeah, okay. So next question is, hi, can you, so this is from Paul. Hi, Paul. Hi, can you set up a limited company after you have already been paid for shifts done last tax year?
Oh, so that was last tax year you already get paid. And it's already paid, like you invoice under your own name. Well, last tax year, I don't think looking at the tax frame, looking at the time frame. Normally, you are not, you cannot retrospectively to accrue like last tax year's income or previous income to your new company income. So if that's already been paid, then that's like done. And then you need to do whatever you need to do with that income. But for any new anything that is earned after your company set up and you invoice under your company name, and then that belongs to your company.
Yeah. And Gemma's asking quickly, can I claim dry cleaning or cleaning costs?
Okay, so of course, cleaning costs, like dry cleaning for your own uniform, for like special clothing, like if the clothing is deductible, and the dry cleaning, of course, it is. But usually for the like general clothing, general dry cleaning on the clothing that you can also wear like in personal occasion, then that is not.
Okay. So Aaron's asking, as a limited company director who books through agencies to work at various GP surgeries, is the company providing staff services? And if yes, will the company have to be registered for VAT, assuming it exceeds the VAT registration threshold in a particular year?
Okay, that's a very good question. Because there are quite a lot of GPs working, like getting shifts from agency. So in this case, so normally when it comes to VAT, if your company, say on the company's house registration, is providing general medical practice, then that is an exempt, VAT exempt service. You don't register VAT. But if that's like providing staffing service, then that's a VAT-able service. But the other thing you need to look at is it's a contract between you and between your company and the agency, or the contract between your company and the client. So it's really how the contract is worded. If that's your company is providing the staff to other practices, or if you are just providing a personal medical service to the end clients. So the contract is quite important.
Okay. So just last few questions now. So Leon, hi Leon. Leon's a salaried GP, 6 sessions a week in one practice, also works locum shifts under a limited company. Is there likely to be a problem with IR35 if I do occasional work at my regular surgery under a limited company?
Okay, so it's again need to look at what the shift is and what the arrangement between your practice and your company is. Of course, you can still carry on working as an employee to your normal surgery, but if you do you have agreement with your normal surgery that I provide the certain session which we have a separate arrangement, and you are not well, I am working as a freelance GP, I'm not being controlled that much, and I'm taking care of my own taxes. So you can actually have a separate arrangement on that. But again, that's really look at what's the agreement on that particular session.
And Leon, if you're using My Locum Manager to manage all this income that's coming in, if you go to the resources section, there's a terms and conditions template which specifies the things to help you with IR35. So you would tick those, or they're already written in there already, but if you are working in line with those conditions, then that would help support you to stay outside of the IR35 issue. So Cha is asking, my business account has a monthly charge. Are there any free ones?
Oh, well, again, it depends on the bank. So yeah, it's hard to answer this question.
I guess you would just look at what's available on the market, really.
Yeah, what's available on the market. I think things like well, there are like websites, or even you can Google like comparison, business account comparison. Or I think one thing, well, which is relatively new, is that they have all these virtual bank accounts. It's just like a normal account, but it's like you have the app. You are approved virtually, and it syncs to your accounting software. It's designed for self-employed individuals. These are relatively new, but yeah, worth exploring. Perhaps they have the free ones out there because they are relatively new.
And Lyra, hi Lyra, is asking, I have a company but have not charged locum work under the company. Can I backdate?
Okay, so as far as I understand, the question was that you have done the work, but you have not built the practice.
So I think she's saying she's done the work, then she set up a limited company. Can she now run it through the limited company, even though the limited company was set up after doing the work? I think that's right, Lyra. Otherwise, by all means, message in and clarify if you'd like.
Yeah, if you haven't built that, yes, you can build that. Use your company name. Yeah, if you have done the work, haven't built, and then perhaps you can say one reason why you haven't built before because you're waiting the company to set up. Your intention is using the company to run the locum business. So yeah.
And someone just kindly, their name hasn't come up yet, but they're saying actually for free business bank accounts, Yorkshire Bank are doing 25 months free. There you go.
Oh, that's very helpful.
And then next question, so I'm going to just take the last couple of questions. I know we got loads, but I'm going to put up our contact slide. So if you've got any questions about local work or portfolio roles or anything, you can message me. If you want advice about tax and accountancy, you can message Hannah. And as we said, like I've got so many requests of different webinars you want us to cover, so we'll definitely get those out. And I'll try and make sure PowerPoint does not crash again. It's never happened to us before. I think we've got just so many people viewing today that it's just it's clearly been really popular. Okay, so just rounding up then. Oh, sorry, Lyra's just clarified. She set up a company, but she has billed them, but in her own name.
Oh, okay. So you build in your own name.
Yeah. So she's worked and then she's building her own name, and then she's gone and set up a limited company. So I guess she's asking, can I backdate it? And
Well, it can be quite tricky. If you have already built, well, it's again depends on if you have been paid to your personal bank account or if you haven't been paid. So it's really in theory, if you haven't paid, you might say, yeah, I just build. My intention is using the company to carry on the work, and then I actually just the company hasn't set up yet, so I just use my own name, or I will override with a new invoice for this shift. But in practical, just to see if the practice would accept that you override a different invoice with your company name. In theory, it's possible to override, but in practice, it's really to see if they would accept that.
yeah, I guess it's worth thinking about what the value of the work build is. If it's going to make a big difference, then it might be worth doing that. So Ajay's got back to us about his innovation vehicle. So I thought that was quite an interesting one. So Ajay's saying his innovation vehicle, so for one session a week, he's doing research in his specialist interest area of dermatology, trying to improve patient outcomes. He doesn't gain income from this work. So I guess going back to his original question was about whether he could get any tax relief from that.
Okay, I think I've got it. What he meant. So
I'm
I
just trying to
suppose
find his original question. There's like thousands of questions on here. They're all really good ones as well. So much needed webinar. So I can't find it. There's just so many here. Ajay, just message Hannah. She'll help you out. She'll like go through everything and just give you some
definitely.
advice.
But I think well, I think I kind of get what it means. Just a little bit brief. So when it comes to innovation, doing research, yes, there is this thing called research and development tax relief. But your intention of doing research has to be eventually developing something. On one side is for advancement of the technology or scientific improvement. On the other side, your intention has to be like eventually earning money, making profit. So if you just do a research, not having the intention of these things, it's not gonna be research and development. But yes, depends on what exactly you've been doing and what's your intention for doing this.
Yeah, okay, great. So we will send out these slides and we'll send out the useful links that Hannah mentioned, and any other useful stuff that we can send out, we will send out to you guys, and make sure that it's as useful and informative as possible. I've now got a list of all the new webinars you'd like us to do. So if you have other ideas, just message me, serena@mylocalmanager.com, and we will happily organise those. I'm now going to very timidly try and put this PowerPoint slide up of contacts so that you can contact Hannah with any other questions that you may have. Matt, do you want to say hello?
Sorry, I'm the tech support here and I'm probably in trouble.
So that's Hannah and my details. And like I said, you can now put your receipts onto My Local Manager. So that's going to hopefully make your lives easier. Things like IR35, terms and conditions, and the expenses you can claim as a salaried or locum GP are all on our resource page. And if you're locuming or you're doing self-employed work, do check out My Local Manager. We've designed it to make your lives much easier, and I'm sure that it will do so. Hannah, thanks so much. You did so well.
Thank you very much.
At the deep end.
Thank you very
much to everyone who joined us today. We had like hundreds of people, which was really lovely. So thank you for your time, and we really hope it was helpful. Good night.
Really appreciate your time. Good night.
Good night.